Welcome to Momentum Monday. Today is August 4th, 2024. Large cap stocks continue to be under heavy distribution. Last week, we saw a brief bounce in the Nasdaq 100, and then right around its 50-day moving average, sellers came back and just slammed it down. Another 3 big distribution days last week. And now futures are down another a couple percent for the Nasdaq 100. So tomorrow they're likely to open under their year-to-date VWAP and near their 200-day moving average. So there might be some short-term bounce opportunity at some point next week and maybe as early as tomorrow if that red open holds. The indices are at this point so oversold that historically speaking, we either see a short-term bounce or we either see a complete meltdown. And I think the former is more likely, but the latter is not to be ruled out. What we continue to see is that tech earnings are still beating estimates for the most part, but the market is looking for the slightest hiccup in those earnings for the slightest reason to really sell. And we saw that last week in strong reports like Meta. It gapped down, but obviously because of the overall market weakness was quickly faded. But anything that slightly misses, ARM didn't miss estimates, as you can see here. They had a 17% earnings surprise, but their guidance was a bit soft. The market is looking for the slightest reason to really sell tech stocks. Same with Microsoft. Also, there wasn't any earnings surprise, but it's still sold off and it's testing its 200-day moving average. So tech is not a safe place to hide, and obviously there are many reasons behind it right now. One of them being super high valuation ahead of this earnings season. Maybe Amazon is one of the exceptions in terms of valuation, but even they sold off on Friday after a pretty strong report, actually. 22% earnings surprise, strong sales growth, better than expected guidance, and still sold off, which comes to show you that there might be some forced liquidation in the current tape, meaning people are selling not because they want to, but because they have to, maybe because they're over leveraged and they're getting margin called. Up until the FOMC, which last Wednesday, we had the small caps holding relatively well. Consolidating here in a tighter and tighter range near their 52-week highs. And then after the FOMC, after the Fed said, nothing has changed. We're keeping the rates the same. We're getting closer to starting a cutting cycle at some point, maybe September, maybe not. And it seems the market was a bit disappointed that it's still dealing with the same Fed that actually caused the inflation problem post-COVID by keeping its accommodative policies for too long. And now the market is thinks that the Fed is doing the same thing, but on the opposite side of the spectrum. They're keeping their tight restriction policies for way too long and probably endangering the economy. And on Friday, as you saw, right after the unemployment report came above the estimates, stocks sold off and small caps were among the hardest hit. So at this point, even if we see a rate cut in September, which the market right now is projecting like an 80% probability that there will be a rate cut in September, and maybe it will be not 25, but 50 basis points. At this point, the market is thinking, oh, they're cutting rates because now they're sure that the economy is entering recession. So those rate cuts their positive effect on the market might be short-lived if this is really what the market believes, that the Fed is behind the curve, the Fed is lagging, it's too conservative, and now they might have caused another issue in the economy, meaning a slowing down economy. We'll see. But as of right now, the small caps pull back to the rising 50-day, and let's see how they react next week. I wouldn't be surprised if we see a light volume bounce towards 215. I wouldn't be surprised if sellers show up here at this level and just use a tight stop here, maybe 2 or 3 points to potentially ride it towards 200. If the market really weakens, it's interesting to see that there's even people like Buffett, they keep raising cash, and Buffett has a very close look at the state of the economy, just because Berkshire Hathaway, they own hundreds of companies in many dozens of industries, including railroads. So he really has his finger on the pulse of the economy and knows what's going on. And if he's raising cash and selling his stock holdings, he must be seeing something that the rest of us and the press are going to see later on. So it's very atypical for Buffett to sell shares. I mean, he said that his favorite holding period is forever, and now we're seeing him reducing some of his holdings. So maybe he's getting ready for more opportunities ahead. Because recessions and corrections are nothing to be feared, because they end up producing incredible opportunities for the prepared. So right now, I mean, despite the sell-off in small caps, we're still seeing rates are coming down. I mean, and typically this has been positive for small caps lately, but not last week. And this drop in rates, as I mentioned, is more of a reflection that the market is expecting a potential recession, and it will be curious to see how it will impact home builders. I mean, they also pulled back and still holding better than the rest of the market, as you can see here, still above their rising 20-day. And obviously, lower rates might help home sales, but not if there is a recession in the economy and many people lose their jobs. Obviously, demand for real estate is going to drop no matter how low interest rates go. But as of right now, one of the industries that is benefiting from falling rates is the mortgage industry, since lower rates means that more people are likely to refinance. And as you can see here on Friday, Rocket company like Rocket Mortgage beat estimates, 23% earnings surprise, and there was a big volume breakout to new 52-week highs. And there were like all stocks really in the mortgage industry are right now showing tremendous relative strength and just breaking out and setting up. Obviously, the valuation of some of them is pretty steep. So they should be more viewed as a trading vehicles, not as long-term holdings. But this is definitely one of the industries that would directly benefit from a significant drop in rates, and we're yet to see one really. So yeah, this will be one of the industries that I'll be paying attention to. So next week, as I said, indices are super oversold. So I wouldn't be surprised if we see some form of a short-term bounce, maybe a dead cat bounce that set up the short setup, the short side again. And the SMH probably is going to open near its 200-day moving average tomorrow. So there might be a quick bounce opportunity here for the Nimbo. You don't need to participate in the choppy volatile tape, but obviously if you're an active trader, those are the best time to participate, especially on an intraday horizon. So I'll probably try a few trades with smaller sized, most likely with options, so I can better control my risk, especially against gaps. Just assuming that any calls I buy, my risk will be the entire premium I pay. So I'm especially interested in SOXO, which is a 3x long semiconductor CTF. It's already down 60% from its 52-week highs. Obviously, it can go a lot lower, but typically we see some sizable bounces along the way in any downtrend. So we might be close to one, especially look at this huge volume on Friday. So as I said, at this point, we either see a meltdown or a bounce. And, I'm kind of preparing for both. Then the other one that I would be interested in trading is FNG, which is 3x long, the tech mega caps. If there is a market bounce, obviously, they might be in play. And obviously, all the tech stocks that are showing relative strength, like Meta is one of them. Apple tried to break out on Friday, but then it became clear that Buffett had continued to sell his holdings. So I wouldn't be surprised if Apple sees some more weakness next week, especially if it loses to 17. I wouldn't be surprised pulling it back towards its at least 50-day moving average. Because if the economy is really entering into recession, guess what? Companies they're selling expensive equipment like iPhones and iPads and so forth, they're going to get hurt. And obviously, another similar company is Tesla. Their sales are going to get hurt if the market really starts to price in a recession. And considering like the movement, the inflows in some of the more defensive sectors like consumer staples, you can see here it closed at 52-week highs, and utilities also closed at 52-week highs. Obviously, those sectors were among the hardest hit when interest rates were rising, just because at that time nobody cared about dividends. Why would you care about dividends if U.S. treasuries are paying you 5%? And now that the rates are falling, all of a sudden those stocks that are paying dividends are back in fashion. And you can see here Philip Morris, new multi-year highs, huge move in the past few weeks. And it's not just about that their new nicotine product. It's just about a flow into defensive consumer discretionary stocks in the past few weeks, as the market has become a little bit more defensive, especially with the yen rallying and kind of causing a potential reversal in the yen carry trade. So that's it. That's it for now. Let's get back to it next week.